Okay, hello, good evening. We are going to be taking one session from Six Sigma, and the topic name is Accounting, Economic and Opportunity Cost. Audible to all? Am I audible? Okay, great. So the moment you hear the word accounting, cost, it's very boring, na? But it's an interesting thing. Before even I used to feel very bored. Okay, so let's start with this interesting chapter. This is good for you, for your future, because healthcare professionals, they're not account students, and therefore they don't know these things. You don't need to know so much in detail, but at least you should know the basic concepts. As leaders, the reason why these topics are incorporated into your course in Six Sigma is because when you all are future leaders, suppose you're going to be a medical administrator, admin head, HR head, your nursing head, any departmental head, you need to know all these things, because only then you can become an effective leader, and you know what kind of cost and expenditure is there from your department, and how you as a leader can efficiently manage the money part. Okay, some of you may be managing directly and some of you indirectly. Okay, so what is cost? It's an amount that has to be paid or given in order to buy something or get something. Okay, so whatever, like if you buy a computer, the cost is the cost of the computer. Okay, in business, whenever you talk about business, it's a valuation of effort, material, resources, time, utilities, risk incurred, opportunity foregone in production and delivery of a good or a service. That means everything is included. For example, if your hospital wants to start, till today your hospital was do outsourcing MRI for your hospital, but now they decided that you need an in-house MRI department. Okay, so it's like a business, right? They've understood that by having an MRI in-house, the hospital can generate profits. So setting up of the MRI, the department, the cost incurred in the employees, everything will be included in the total cost. And the time, like in how many years can you get back the money that you've spent, all that will be considered in the cost. Okay. So what is the cost? It's an amount that has to be paid or given up in order to get something. Effort, materials, resources, time, utility, risk incurred. All this will be considered in the cost. Now, there are three types of cost. So there are many types of cost. If you are a finance student, they have many topics. So what are costs? They are the resources used to make a product. It is expressed in monetary terms. Indirect cost, fixed cost, variable cost, direct cost, operational cost, and many more costs are there. Now we will look into three main parts: accounting cost, economic cost, and opportunity cost. See, there are another group of costs: initial cost, opportunity cost, time cost, operational cost, hidden costs. We will look into this one. The three different types of costs: accounting cost, economic cost, and opportunity cost. At least this much you should be able to understand. Okay. So what is accounting cost? In business and accounting, cost is the monetary value that a company has spent in order to produce something. Okay. So accounting costs are the actual or outlay costs that point out the amount of expenditure that has already been incurred on a particular process. Okay. In accounting cost, there are many costs. Like suppose now I gave you the example of the MRI department. Okay. Any department you can have in a hospital. Okay. Or any training that you do. Cost accounting is an accounting process that measures and analyzes the cost associated with products, production, projects, so that correct amounts are reported on financial statements. Okay. The types are direct, indirect, fixed, variable, and operating cost. Let's look into that. Accounting cost can be defined as a cost of the activity as recorded, like what I told you just now. Okay. Direct cost, indirect cost, fixed cost, variable cost, semi-variable cost, and opportunity cost. We'll deal with some of these. Okay. Now, direct cost. A direct cost is what? It is related to producing a good or service. Okay. It is a material, labor, expense, distribution cost associated with producing a project. It can be accurately and easily traced. Like anybody can tell you. So, like suppose you buy a house, the cost of the house, the maintenance charge, everything will be included. Okay, suppose a worker spends 8 hours to build a car for a manufacturing company. So when the direct cost, the car, that car will have to pay the wages for the worker also and the parts that is used to build the car. So effort of that worker and also the parts of the car together will come as the direct cost, which you can it's obvious cost, the direct cost. Okay. Now, what's an indirect cost? Indirect cost is an expense unrelated to the producing of a good. Indirect cost directly you cannot trace. It will not click you. You have to think. A businessman can only understand. Okay. For example, a semiconductor company rents office space in a building and produces some microchips, batteries, some things like that. Okay. The wages paid to the worker and the material used will come under which cost? Which cost will come under that? Come on, you all tell me. I want to know whether you all are paying attention. Yes, thanks, Vinny. That will come under the direct cost. Okay. Now, the electricity used for the building, that all will come under the indirect. Thanks, Binya. So, direct. So, direct will be the cost that you can actually understand. And, like, for example, in simple language, if you're doing a cooking business from your house, you wanted to prepare 1 kg chicken curry, somebody has given you the order. Okay. Cost of the chicken, oil, all that will be considered as your direct cost. What can be the indirect cost? fair. Indirect costs will be like, the gas, correct. Cooking gas, then you have to buy that chicken 1 or 2 days previously, so you will refrigerate it. So that electricity charge, the refrigeration charge, sometimes you will not consider all that because fridge is already there at home now. So what to consider? So these are all. Okay. So this comes under indirect. So now you understood that indirect cost. Okay. This is difficult to track back. Okay. Next comes the fixed cost. A fixed cost is also called associated with cost accounting. It does not vary with the number of goods or services. Now, what is a fixed cost? Suppose you in your organization, you are renting out a machine, like a ECG machine for use or a ventilator for use. On a monthly basis, you have to pay $1,000 or $2,000 per month. Okay. This is your fixed cost because it will not change. Every month you have to pay that. Correct? For use. Baki your profit, sometimes you might not get that much profit also, but that is your cost because you are renting out that particular machine. That is your fixed cost. Now a variable cost. Contrary to a fixed cost, a variable cost fluctuates as the level of production output changes. This type of cost varies depending on the number of products a company produces. For example, okay, what to say now? In this book only there's an example. A toy manufacturer, suppose there's a shop which is manufacturing toys. In the month of January, February, they were manufacturing, the production was depending on the requirement. It was around 100 packets of toys. So you required just 3 employees. But then now as the sales have increased, in the month of June, July, August, more than hundreds have been produced because more demand, like around 1,000. You need to increase the number of employers also, right? So you can't just have 4 people. You will need around 6 to 7 people or 8 people. So this is considered as a variable cost because as the manufacturer produces more toys, its packaging cost also increases and the number of people to be employed also increases. Variable cost associated with packaging decreases. Okay. Fixed and variable costs affect the profit of the company. Okay. Overall profit will be affected. It can increase because more you're producing, but depending on how you utilize the manpower. Okay. So direct cost, indirect cost, fixed cost, variable cost, semi-variable, too much in depth. We don't need to discuss that. Let's talk about operating cost. An operating cost is an expense associated with day-to-day business activity. It can be variable or it can be fixed. For example, an operating cost in a company inventory. Suppose a company produces and sells microchips. You know the storage, it has to be maintained, it has to be stored, what temperature it has to be stored in, what kind of a room it has to be, which is an operational cost. It can also be used to calculate company's operating expense ratio. Okay, to operate something. Now, suppose a computer, you need air condition, right? So operating cost that comes under the operating cost. Okay. So operating costs that are associated with maintenance and administration of a business on a day-to-day basis. That is called your operating cost. Now let's move on to economic cost. Economic or economic cost. These terminologies are very interesting actually. The goods to be taken into consideration are money, time, and resources. The comparison includes the gains and losses precluded by taking a course of action. So economic cost differs from accounting cost because it includes opportunity cost. Look at this slide. Accounting cost is actual expense plus depreciation charges for a capital equipment. Okay. So like a car you buy for 5 lakhs or 6 lakhs. By the 14th or the 15 years, you can drive it, right? By 11th year, now you will have to spend more time, money on maintenance, right? That is all included in your accounting cost. Now, what is economic cost? Economic cost to a firm of utilizing economic resources, including opportunity cost. Now, this word opportunity is very interesting and it is very important for each one of you. Okay. Very easy for you to understand. I'll tell you. You have you have a holiday today. Okay. Today none of you are going to work. And you went and watched a movie. Actually, you're working on a project in the hospital, some infection control project, and you have a presentation to be made. Okay. And after that presentation, it has to be, there's a lot of work in that. So today, you went for a movie, which was actually not a 2.5 hour movie, it was a 3.5 hour movie, a long movie. And then you indulge yourself in some outside shopping and all, and you came back. Almost you spend around 7-8 hours. Okay. Now, when you consider business and when you consider this project of yours, what better you could have done in this 7 hours becomes your opportunity cost. It's like you had the opportunity, you could have actually done your work. So by tomorrow, you could have submitted the project, but you cannot because you already watched the movie. The loss that happened and what opportunities you could have created in that time, that is called your opportunity cost. Okay. So when you take an economic cost, my chances of doing better things. Okay. Suppose I don't want to use the car for 15 years. I feel in the last 2 to 3 years, the car is not going to give. Rather, I would sell that car at seventh year. Okay. I would sell the car at the seventh year because till 7 years it was running very smoothly and buy a new car considering all the positives and negatives rather than dragging it till I pull it off, till I use it till 15 years, and then buy a new car, where that cost would have been more for a newer car when you consider all this. I hope you understood that. So, opportunity cost, when economists refer to opportunity cost, they mean the value of next highest valued alternative use. For example, you spend time and money going to a movie, you cannot spend that time at home reading a book. Okay. And you can't spend money on buying a book. Buying and reading a book might have given you better financial results versus a movie, right? Now you'll tell me, Ari, I wanted to relax. Reading a book also is relaxation, which would have helped you more. So, an opportunity cost, that is. Okay. What is the concept of this? Opportunity cost is a key concept in economics and has been described as expressing basic relationship between scarcity and choice. Okay. In opportunity cost is also known as an alternative cost. Now I'll give you some more examples. In healthcare, if a patient develops hospital acquired infection, okay, it will prolong the hospital stay. Though hospital might get revenue from this patient. Suppose CABG patient. Normally, how many days will a CABG patient stay in the hospital? Especially in the ICU. Come on, tell me. A cardiac surgery patient, normally, on an average, how many days does they stay in the ICU? How many days? Yeah. So 3 to 4 days. Fast track is 7 days discharge. So 3 to 4 days in ICU, then into wards and discharge. 6 to 7 days में उसका discharge हो जाता है, right? So now on the third day when he was supposed to be shifted into the ward, he develops an infection. Okay. So now what is happening? Like almost 4 or 5 patients in the ICU developed infection. All those 4 or 5 patients, instead of shifting to ward on the third day or the fourth day, they will be treated for the infection and then shifted to the wards. So around more 4 or 5 days. Okay. Now you are not able to take new patients into the ICU because the ICU is full. Okay. Hospital is losing profit because when the patient is getting infection, he is just going to be charged for that hospital that day of the ICU. Okay. Whereas a new patient, the first 4 days is the revenue for the hospital because the moment he comes into the hospital, the investigations that has to be done, the charges that have been incurred, that is a maximum. If you see the procedure that is done, in the first 2 to 3 days, the procedure is done for a patient, right? That is the profit for the organization. So if you just have a patient in an ICU, because ICU bed has to be full and he is just being treated for an infection, There's no profit in that. Okay. So a new patient could have been admitted in the hospital and would have brought more revenue to the organization. The difference, that is why hospitals don't want infection. The difference in the revenue bought by these two. An infected patient sitting in lying on the bed, and a normal patient coming, a fresh patient, it has two different revenues. Okay. It's an opportunity cost. Remember that hospital manager is always interested in faster turnover and faster discharge of a patient, because any patient brings in more revenue during the first few days when most of the interventions are performed. After few days of hospital stay, revenue from the patient begins to drop. They're just paying for the room charges and the medication that they use. Okay. Not all, few. Few may be different because of the condition, like they must be using a CRRT machine and all that, but otherwise in on an average, on a general. Now similarly, a delayed discharge of a patient delays admission of a new patient. Correct. These delays get built up, leading to refusal to admission to new patient. Thus foregoing revenue which new patients would have bought is lost. So this is the opportunity cost. I missed it. Understood? We miss it when we don't consider these things. Understood, everybody? So, in economic cost, accounting cost, you're not looking at all this. You're not looking at the opportunities that would have given you a better profit. Okay. Economic cost. A simple example would be another one. You are in the current organization and you got your increment, which is around 10%, around 10% only increment. Okay. You're living in that organization since many years. You're getting 10%. So, but if you had to leave that job and jump to another organization, would have given you 20% hike, and consider the number of years. Now you understand the opportunity cost. I'm not telling you to run away from your organization. I'm just telling you, I'm just giving you an example. Okay. So that's the opportunity cost. Understood? Opportunity cost is commonly defined as the next best alternative, also known as the alternative cost. It is a loss of gain which could have been gained if another alternative was chosen. It can also be explained as a loss of benefit due to a change in choice. One more interesting thing you need to understand: return of investment. Okay. Return of investment, net investment gain upon cost of investment into 100 is a percentage. Okay. What is the return of investment? Normally, when you buy a property, they say in a year, return of investment will be around 3 to 4 or 5 to 6%. If it's a good decision that you made, return of investment. Okay. They say for gold also, it could be 7, 8%. What is the return of investment? Okay. So it's basically, suppose we recruit a person, you are recruited into an organization at 40,000 salary. Okay. I have to get the return of investment for what work that person is doing. Okay. If you recruit one maid at your place for 4,000 per month, okay, and that maid just sits at home and does nothing, would you keep that maid? No. So this concept you understand, you don't need to learn the formula. Whenever somebody recruits you, they will calculate the return of investment. They will check, if I recruit this person, what is the benefit? If I do this, simple example, some of you have spent 10,000, some of you have spent 30,000, some of you have spent 1 lakh, 45,000 on NHCA courses. Okay. I'm just giving you a simple example. Like just recently, one girl, she received her certificate 2 days back. Okay. She already got the infection control post, but without the certificate, you cannot apply, right? So she got the certificate finally. So her salary was around 30,000. Okay. Now she gets the post of infection control nurse. Salary has increased to 35,000. Don't look at the increment value, but On a monthly basis, you're increasing of 5,000. And also, you don't have to do your shift duties. Okay. This is all coming under it. So she spent around 15,000 for the course and she is getting 5,000 every month. Multiply by 12. 12 5s are 60. 60 se minus karo 15,000. That's a return of investment. Now it's not ended year. Every year she's going to get. You understood when you invest in something how it is. If you would have spent that 15,000 on something else, it is not value for money. Okay. So return of investment is a net investment gain upon the cost of investment into 100. That is your return of investment. Okay. So these were the topics. So what all we covered? Let's revise once more.